Hi, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. Also in the room is my colleague, Victor. Hello, Victor. How are you?
Hello, Fawad. Pretty good. Ready to discuss some of the latest developments across markets.
I look forward to that. So obviously, we are going to talk live on the charts, providing mostly technical analysis, but Victor has, as always, really interesting fundamental views as well. So I look forward to hearing those thoughts, Victor. But for those of you who are, who have joined us live, please ask us questions. And for those of you who are watching the recording this, please consider joining us live next time so that you can ask us questions, and we will be more than happy to provide analysis on any markets that you guys are after. But before we start the webinar, please have a read through the disclaimer and risk warning, and I'm going to help you by reading the first paragraph, okay? These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this webinar happens every Tuesday, 11:30 London time. Please make sure to join us for the next one if you're watching a recording of this. I mentioned we provide, technical analysis and also some fundamental as well analysis on the major currencies, gold and indices, as well as commodities. Obviously, there will be a Q&A session at the end of the webinar. Now, in terms of this week, we have some key macroeconomic events coming up, both from the US and elsewhere. In the US also, we have lots of company earnings coming out this week. And so there's plenty to look forward to. From this calendar, Victor, does anything stand out to you? For me, it's the European Central Bank meeting. What about yourself?
Yeah, most certainly. That's the the hottest item in there, along with the PMIs from the Eurozone. And the US on Friday. We have had a bit of a quiet week
so far,
in terms of data, so far, and starting from tomorrow, we're going to see some lively moves over there.
Yeah, and even if you look at the data for Wednesday, we have CPI as well from the UK, New Zealand, and Canada. Australian retail sales, that should move the Aussie dollar. Bank of Canada policy decision. Now, the Bank of Canada is really important because they have kind of turned a little bit hawkish. The first kind of major central bank to indicate that the emergency measures that they took during the pandemic is going to end. So they're going to provide some details on that. I think should be interesting to see how the Canadian dollar will react. So far, the Canadian dollar has been one of the strongest currencies out there. And it's all to do, obviously, with ongoing risk on sentiment, as well as the Bank of Canada turning hawkish and crude oil prices rallying to, they found renewed strength in recent days, haven't they? So that's all helping to fuel a rally in Canadian dollar. Not too much data from the US, I think. I'm just looking at the calendar. But yeah, as Victor mentioned, those flash PMIs are going to be important for European data. The latest pickup in vaccinations in the Eurozone, finally. Let's see how that has changed sentiment among businesses or the purchasing managers of the manufacturing and services businesses in the Eurozone. It will be interesting to see that. We also have UK retail sales on Friday, so bit of a busy week for UK. retail sales on Friday. On Wednesday, we have CPI. Today, we had wages and jobs data. Came out a bit mixed, but the pound kind of shrugged it off. The cable was already rising really sharply for the last couple of days, so it has eased off those highs. Touched to 140. It has eased off the highs, but the trend remains strong for the pound, and we're going to cover the pound shortly when we look at the live charts. In fact, let's now look at the live charts, and I'm going to start off by looking at the dollar index. So the dollar index is, well, it's weak, isn't it? I mean, this is the weekly chart. Rather, this is the monthly chart of the dollar index, and what you can see here is the dollar index has basically given back the entire gains it made during March, and it should have held kind of around this level at 91.60ish, which was the prior resistance level. It has gone below that, suggesting that the longer term downward trend that started in March of last year has resumed for the dollar index. And looking at the economic data, we had some really strong numbers from the US. We had the non-farm payrolls report, which came out at something like 900,000, which was really strong. CPI.
Yeah, and ever since then, the dollar hasn't stopped falling.
Exactly. So it's always the reaction to news than the news itself that's more important. And with the dollar index or the dollar as a currency not responding in the way you would expect, you'd have to think, what's going on. And the way I see it is, given the recent big rally in the major stock indices and until a few days ago in Bitcoin and a few other risk assets, it's all to do with reflation trade. It reminds me of the sort of price action we saw since everything bottomed out in March of last year. So the likes of Aussie dollar has come back really strong. The pound has come back really strong. Even the euro has climbed above 120 handle, which is something we're going to be talking about shortly. But the reason the dollar is weakening is because of ongoing drive into the more risk-sensitive assets because of growing expectations that the world economy is going to recover really strongly thanks to the deployment of the vaccines in some of the world's most important regions. In the US, the pace of vaccinations are really fast, and so is in the UK and a few other places. And the Eurozone has finally got its act together as well, where the pace of vaccinations have been ramped up sharply in recent times. So that's why the dollar has really failed to show the kind of bullish characteristics you'd have expected with a rebounding economy. Now, looking at this chart, the daily chart of the dollar index, this region here was the prior kind of support that led to that big move up, or relatively big move up. That region should have held as support when it came back down. It didn't, and instead we've broken down. So going forward, this shaded region is likely to be a key resistance area if the dollar gets to it, from where we should see a reaction to the downside, I think. Obviously, if it starts to move above it, then at that point, you'd have to consider the bullish argument for the dollar once again. There's also this trend line that I can draw connecting the most recent highs. And so long as we remain below that trend line, the path of least resistance for the dollar should remain to the downside. Now, in terms of downside targets, the 61.8 was almost tested earlier this morning before the dollar bounced. So that is an important level, I would say, because if you look at the shapes of these candles, you can see that there's been lots of price action around that level. And Below that, there's really not much further support, to be honest, until possibly the prior year low, the 2020 low at around 89.50-ish. This year's earlier low comes in at 89.20. It will be interesting to see if the dollar will go on to retest those lows in the days and weeks ahead. But yeah, currently the path of least resistance for the dollar index is to the downside. So with that in mind, let's now look at a few major currency pairs. And I'm going to start off with the pound, actually, because as I mentioned, the pound has had a really strong few days. It broke out of this bull flag pattern after holding its own above this key support area, which was the high from last year. Last year, the pound closed near the highs, and the pound closed near the highs last year. And once we've broken above the high from last year, look how it went up without coming back down. But then it eventually stalled. Rates then went into a period of consolidation, came back down to retest that level, bounced, came back down to retest it again, and it bounced, so forming a double bottom there. And then eventually it broke out of this bull flag pattern. So this is a key technical development for the for the pound, and it has kind of reached its short-term objective at the 140 psychologically important level. But I think more gains should be expected, given the overall bullish price structure and the improving macro backdrop in the UK. So what I'm expecting next in terms of the pound is, this sharp two-day rally has been really fast. So if you zoom into your lower timeframes, we should get something like, or we could get something like this, like a consolidation inside a wedge pattern or a triangle pattern. And then
perhaps a test of 139.20.
Exactly, this blue line here. Yeah. So yeah, perhaps a test of that
would be a level to look at if you want to start buying the pound.
Yeah.
Probably that could serve as a support level.
Yeah. Yeah. So 139, call that 129. 139.20. It basically corresponds with this high, is what Victor is pointing at. This was the last resistance, which is now broken. So a retest of that could potentially pave the way for more gains. If it doesn't reach that level and instead consolidates in here, then you could look to potentially trade the breakout from a continuation pattern, like a triangle or whatever. So there are different ways to trade it, but the key point here is that the path of least resistance is to the downside as things stand. Is to the upside as things stand. Euro dollar is going to be very interesting. Let me just clear this chart a little bit. It's too much going on here. Okay, so the euro dollar has bounced back like the cable, and it has climbed above the 120 handle, which is right here. This 120 handle is going to be pivotal, right? Look how the euro has reacted every time it's gone above or below it. It came up here, tested it, and it slumped. Look how long it has spent below that 120 handle before going above. Once it went above, it spent several days, several weeks, months even, above at this area before breaking down. Once it broke down, it went down to go on to test the 117 handle, 300 pips from there, before storming back above this level. So now that we are above it, given the past price action, the path of least resistance is clearly to the upside. But we have a key risk event this week, or two key risk events for the euro dollar, namely the European Central Bank meeting and those PMI data that come out on Friday, as we spoke earlier about.
Yeah, the ECB is not very fond of the euro-dollar exchange rate climbing above 120.
Yeah.
That's where we have seen in the past some verbal intervention, so to say.
Yeah.
Not that it has done much
right.
in the past. But if we if we close this week above 120, that would probably be a signal for dollar bulls to start capitulating and eventually exit their positions, which could accelerate this move that we have seen higher.
Yeah,
I'm not particularly fond of going long on the euro from here.
yeah,
And the main reason for that is that it's been a kind of a one-way move
sure.
over the past month, really. Well, 3 weeks.
Yeah.
So the key here is to observe how the market behaves over the next 4 sessions, really, until the end of the week. And we have seen some cracks appearing in risk assets, and that could boost the dollar at some point.
Yeah, so you're talking about stock indices, coming off the highs, obviously. If you look at the German DAX index, big rally earlier on Friday. Last couple of days come back down. Still very near the record highs.
Worrying.
Yeah, but it is a potential warning sign. Yeah. Same with the S&P 500 reaching the 161.8 extension and surpassing it, but struggling to stay above. Nasdaq is tried to break its previous record high. It did, but it's kind of struggling.
Not really.
So same picture everywhere. The Russell 2000. This one has lagged. Potential head and shoulders. We shall see. The Nikkei index is looking quite bearish, doesn't it, at the moment? It still holding up.
Nikkei is probably one of the more key indices for risk assets, meaning that when the Nikkei breaks down, you know that something's wrong.
Something's wrong, indeed. One market that no one talks about much is the Chinese equity market.
Yeah, the Chinese market has been terrible.
Doing really poorly. Like the reason for this is obviously the withdrawal of kind of support, isn't it, stimulus in China. And as things improve in the Western world, in the US and Europe, as economic data improves and inflation rises, central banks on this side of the world are going to start withdrawing monetary support as well. And I wonder what that would do to the equity markets. And, given that equity indices have kind of tracked the balance sheet, the expanding balance sheet of the Fed and other central banks. Now, when those central bank balance sheets start to shrink, are we going to see equity markets go down with a shrinking balance sheet of central banks? And my guess is probably yeah. So I would be very careful, trading the equity indices at these elevated levels, insofar as the US is concerned, or indeed European indices like the DAX. French index as well has had a really strong rally in recent times, but like all the other major indices today, it's coming down quite noticeably. The trend is obviously still bullish. I wouldn't necessarily say, I wouldn't advise, or we don't provide advice anyway, but I wouldn't say, you should be looking to sell. But I'm saying that if you are still bullish, just wait for the indices to retreat to more strong support levels, and wait for confirmation, and be a bit nimble if you do go long at these.
There are some concerns related to the latest COVID stats, actually, that we have seen over recent days, record cases globally.
Yeah.
And the fact that the developed economies have started distributing vaccines is not helping developing economies and emerging markets to roll out their effort.
Yeah.
We have seen the Chinese vaccine being, kind of discredited, but by some Chinese officials who have admitted that it's not very effective.
Yeah.
And the growing variants of COVID-19 that have engulfed countries like Brazil and South Africa, especially Brazil, where death cases have imploded in recent weeks, and the situation looks really, really bad for that country.
Yeah.
And some European states have suspended air travel from Brazil, and South Africa is another one. But the fact that the market basically started pricing in everything is back to normal in November of last year, and if we don't get back to normal, we're going to have another repricing event. So beware of that possibility. It's we're not out of the woods yet in terms of stats.
Yeah, indeed, we're not far from it. Just putting the 200-day moving average back on the charts. This is the South African rand. You're talking about South African rand. It's very interesting that it's still looking really strong, isn't it, against the dollar, despite the troubles there. Likewise, Mexico, another emerging market currency, very strong.
Well, these currencies are closely linked to the prices of commodities, and that's the primary reason for them rallying over recent months.
Yeah.
So, the only exception is probably the Russian ruble, which has suffered due to the escalation on the Ukrainian border and the sanctions that have been announced by the US against it. But nevertheless, I think that the further moves in such currencies are strongly dependent on the prices of commodities.
Yeah. So speaking of commodities, let's now look at a few commodities. And, one particular commodity that's looked really strong in recent times is the price of crude oil. It broke out of this triangle formation to the upside. I was expecting it to go down, to be honest, when it was trading around 60. I was waiting for a trigger. My trigger would have been a breakdown below the support line of the triangle. It didn't quite happen. It instead went up. And I think that was because of renewed optimism about the reopening of the global economies after the pace of vaccinations in the Eurozone picked up. It's kind of reached its target, I would say, from this triangle breakout. At least first target. If I draw the Feb retracement, you will see that it's around 61.8 Feb retrace. Yeah. Testing the 61.8 Fibonacci retrace against the 2011 high. So it will be interesting to see what happens here. So far, it's looking bullish, but if it breaks these lows here, so if it breaks below the low from yesterday, really, that would invalidate the bullish argument in the short term, because price has created a mini structure here. It's created a new high above this high today. So from a bullish point of view, you shouldn't go below that level now. If it does, then it will potentially pave the way for a correction back down to around $60 per barrel. we could see something like that if this level breaks. Otherwise, if this support area holds previous resistance, I would expect a continuation higher, not too high, but possibly around the 60, 65, 60, the 2020 high. And we may go on to retest this year's earlier high, which was here, before prices potentially come back down. Overall, I'm not really expecting too much upside for crude oil from here, because I think a lot of the positivity has been priced in.
Yeah, and what do you think about potential renovation of a deal with Iran? That could
Oh yeah, so Iranian supply could come into the market.
Yeah, significant impact, and I think that the market is kind of ignoring the talks that are going on right now. I just saw this morning an Iranian official commenting that the talks are going in the right direction.
Yeah.
So I assume this was the moment where crude oil pulled back from from today's high and is now consolidating near yesterday's kind of range. So we'll see what happens next. But I certainly think that the market has forgotten about a prospect of Iranian supply coming back to the table, and of course the leverage that Russia had is diminishing every day, I think, because of its geopolitical stance.
Yeah, that could be some interesting development there regarding Iran. If crude oil exports are, if the restrictions to export crude oil are lifted on Iran, I still think it's going to take time, but if that happens sooner than expected, maybe that could potentially send crude oil tumbling. Who knows? But yeah, in any event, I don't think crude oil is going to rally significantly from here. I think it may still rise a bit more given what's happening with other risk assets, but I'm not too positive longer term. What about gold and silver, Victor? They've come back strong, haven't they, in recent days?
Yeah, so I'm going to mention once again those geopolitical tensions that kind of coincided with the increase, with the start of the increase in the price of gold a couple of weeks ago. Gold was just on the verge of breaking below 1680, and then this attempt failed miserably, and we have seen a short covering that basically pushed the price above 1760 and 65 area, which was kind of important. However, this break could be false. I'm not positively convinced that we're out of the woods for gold bulls.
Yeah, I am also not too sure on gold at the moment. On the one hand, the dollar is weakening, which should be positive for the price of gold. Geopolitical risks are rising in some areas. Equity valuations are sky high, meaning that there could be haven flows into the precious metal. On the other hand, the factors that you mentioned, as well as bond yields, still on the rise in most areas. This is the German 10-year yields. It has come back down a little bit today. Generally, though, it's been rising. In the UK as well, government bond yields have been rising. Right now, consolidating, but the trend has been bullish. And US 10-year bond yields have started to come down, though. So that could be something that may support gold going forward. The 10-year failed at 175 right here when it had created a high. Tried to break that high, couldn't, went down and took out the low that was created prior to the rally. Now that we've gone below it, let's see if this shaded area, which was previously support, turns into resistance. And if that area does turn into resistance, then perhaps gold could come back strongly, because when yields fall, the opportunity cost of gold falls as well in a relative basis. Or put another way, when bond yields rise, the opportunity cost of holding gold, which is an asset that doesn't pay any interest or dividends, it rises. So in other words, bond yields have a negative correlation with gold prices. When yields fall, gold prices tend to rise. So keep an eye on this if you trade gold or if you invest in gold, because if yields start to go down from the shaded region, then we could see a more pronounced sell-off in yields and a rally in bond prices and a rally in gold potentially. So technically speaking, gold has broken out. What happened to the other chart? I had another chart of gold. I think it was, it's gone. Anyway, there was a, oh, right, I see what I've done. It's here. Gold has broken out of the consolidation pattern to the upside. Sorry, not consolidation, what do you call this? A falling wedge pattern, which is meant to be a long-term bullish continuation pattern, right? Also notice we had the pre-pandemic high marked out right here. So before the pandemic started, gold was rising, and then when every country went into lockdown, it slumped, right, like the rest of the financial market, before staging a massive breakout. So if gold was rising before the pandemic, why should it not be rising now, is a question gold bugs would be asking, because now we have more central bank stimulus, we have lower interest rates, we have more fiscal spending, more reasons to be risk averse, really, which is potentially positive for gold. Also, there are more risks of inflation overshooting. So from that point of view, I think the risks are skewed to the upside for gold from here.
As well as some others, and this is to debate shoring up of national stockpiles of vaccines.
Sorry, Victor, can you hear me, because I think I've lost my audio. I think it's back on now. Anyway, silver has also broken out of a falling wedge pattern. It's trading around the $26 level, which is a significant level. If it starts to...
there's been a lot of price action around this level. The previous time prices fell from 26 to 24. There was a significant consolidation around 26. So let's see if that repeats.
Yeah, indeed. Notice the 200-day moving average is held for now as well, which is a long-term support, really, if you think of the 200-day moving average in that regard. And the fact that it's rising as well is another reason to pay attention to the 200-day moving average. So yeah, let's see if silver can push on from here. Silver is obviously used in many industrial purposes, and at the moment in renewable energy sector, silver is used in... Where is it used in Victor? Do you know precisely?
Wind turbines.
Wind turbines, that's it. and solar panels I heard as well. So there should be growing demand for silver as the world turns to greener energy, or turns its attention to greener energy from fossil in the coming years. So long term, I think I'm bullish on silver. Short term, the technicals look bullish. I think we need to break through 26 to the upside to trigger a strong bullish continuation. We need to break that level on a daily closing basis. Right now, we haven't got a daily closing basis above, but it could happen soon. Support comes in at 25.50-ish, which was the base of the breakout from this consolidation range. Okay, we have run out of time. If you have any questions, for those of you who have joined us live, please ask us now. I can't see any questions being asked at the moment. So I'm going to give you a couple of minutes. If you have any questions, please ask us now before we end the webinar.
Yeah, and we can have a look perhaps at Bitcoin in the meantime.
Sure.
As that's something that has moved a lot over recent sessions.
Indeed, it has.
We have seen a test of the 50-day moving average, which in the past has served as a as a strong level of
Did you say
support.
50-day?
Yeah, the 50-day moving average.
Let me add that as well. Moving average. Let's color that in black, shall we?
Sure.
50-day. Okay. So yeah, it's black level line here.
So yeah, it has been a support for a couple of moves downward first in February, and then in March.
Yeah.
Sorry, it wasn't in it wasn't
earlier
in January. Yeah, in January, and then in March, and now we're trading below it for the first time in a while. So let's see if the bulls can retain control at these levels.
Yeah, looking at the longer term charts, obviously we're trading at record levels. There's no point of going back. But the reason I'm looking at this is just to plot the Fibonacci's from the 2017 high to the low that was reached in December 2018, and look at how it has gone through all the major extension levels without it did pause, but it's taken at all those extension levels. So in other words, Bitcoin is, fundamentally obviously it's bullish, but technically it does look very overbought on the longer term charts. So please bear that in mind if you trade Bitcoin. On the daily, I think we need to get a decisive lower low before we turn bearish on Bitcoin. This level here, around 50,000, just above 50,000, 50,300 was the last significant low that was created prior to price making a new high. So I think that level is the line in the sand. If we break below that, we will also take out this bullish trend line, which could then pave the way for a deeper correction. How deep, I don't know, because every time Bitcoin dips, people are, they just jump back into it. In every little dip. So whether or not we'll break that remains to be seen. And if we do break it, how far we could go down, again, remains to be seen. But this level here, 55,400 is very important because it ties in with the interim low that was created prior to price breaking out. It's likely that some of the weaker hands that had their stops placed below this level, they were taken when price slumped a few days ago on Saturday. Was that Saturday or Sunday? 18th.
Sunday.
Yeah, that was Sunday. We formed an inside bar candle on Monday, this candle here. So if I mark out the high and the low of the inside bar, the inside bar is formed when the range is engulfed by the previous day's range. Okay, so what happened at the start of today's session, we broke the low of that candle, took out the stops there, but there was an immediate refusal to hold below that, which is a potentially bullish scenario because it indicates there was lack of selling pressure below that level to cause prices to continue lower. So there was no continuation once that level broke. And the fact that we've gone back below this black level suggests to me that perhaps Bitcoin is trying to form a base here. And from here, the most logical level to go to next would be to take out the high from Monday, where above which there'll be stops resting, right? So, if you think of the market as a function of liquidity, it goes from one area of liquidity to the next area of liquidity. And for me, it looks very likely at this stage, just looking at this daily chart, that price will want to go above Monday's high and test liquidity above the inside bar high. What it does after that remains to be seen. Key resistance comes in at the shaded region, previously support and resistance. We could see a nice reaction once ORF price gets there. And over there, we also have the Fibonacci retrace, the 61.8. Yeah, we do, just below. So there's lots of technical levels converging in this shaded region. So if Bitcoin were to get there, we may see a pullback down to 57,600, which is the high of Monday's range. And then from there, we could bounce again. But yeah, we'll cross that bridge when we get there. Right now, though, it's starting to look a little bit positive once again. It does need to reclaim the 50-day still, but from a purely price action point of view, I think it's trying to form a base. If you are a short-term trader, perhaps keeping an eye on the hourly chart makes more sense to you. Then, there are a couple of trend lines that you could watch. This one has been taken. There is this level right here. So this was I think this is the Monday side. This was the high prior to price making these lower lows, right? It needs to break that high to trigger a change in direction. So if it moves above this blue level, I think that would be the turning point for Bitcoin in the short term anyway. And in terms of the next level of resistance is, this level right here is important because this is the low that was made prior to price collapsing in this next hourly candle. So that level hasn't been retested yet. It could offer some a tradable bounce there if it gets there. Right, I still can't see any questions from those of you who are here.
No questions.
It means that you are happy for us to end the webinar. So thank you once again for joining us. I hope you found this webinar useful. For those of you who are watching this live, watching the recording of this webinar, please join us live next time. You can do that by going to our website, thinkmarkets.com, go to Market Analysis, live webinars, and then you can see a list of live webinars coming up in this site. And then you basically click on the register button to register for the next one, and you'll get an email with the link to join us next time. Until next time, take care, guys.
Take care. Bye-bye. Good luck.